Hey guys, Nathan Sprague here with Guardian Financial Group. I wanted to shoot a really quick video to help explain how these index crediting strategies work. And I'm not going to get into all the details of the mechanics of how the investment itself works, but more importantly, the net effect of how the strategy works. So, first and foremost, let me explain and clarify that these are technically not considered what we would call investments. Your money is not actually invested in the market. This is what we refer to as a synthetic investment. And before I get into any confusing language, let's just kind of dive into how it works, because that's the most important thing. So basically, the way these index crediting strategies work is that your account and your money is tied to a market index, like the S&P 500, or it could be a number of other index funds, or it could be a combination of index funds. And your money tracks and grows with that index, and you get to lock in those gains on that index every single year. However, there's typically a cap or some sort of restriction or limitation on the maximum gain that you can be credited each year. But the trade-off for that cap on your gains is that you're also provided a downside floor of 0. So if that index goes negative, and the market in general or that index specifically goes negative and loses money, you are protected against any losses in any and every given year. And as a result, your account balance can never move backwards. So just to quickly touch on the upside limitation, there's typically two limits, or two types of limits. Number one is just a simple ceiling, or what they call a cap. So for example, if there's a 15% cap, if your index that your money's tied to, say, gains 13%, then you're going to be credited with the full 13% gain because you didn't reach the cap. But let's say that index gains 18%. In that scenario, you would simply be capped at a 15% gain that year. The other scenario is a limitation in what they call the participation rate, which is really just providing you typically no ceiling or no cap on the maximum amount of gain, but you're only given a percentage of the gain. So I'll use another example. Let's say you have a 70% participation rate, but no cap, which means let's say the index that your money's tied to gains 20% in a given year, and you have a 70% participation rate on that index and that strategy. Well, that means that your account would be credited with 70% of the 20% gain. So in that case, it would be a 14% credit. So those are the two ways in which you're typically limited a little bit on the upside. But as I mentioned, in exchange for that cap or restriction and limit to the upside, you are given a downside floor of 0, and you cannot lose money in any given year. You get to lock in those gains every single year and never run the risk of your account balance moving backwards. So what does that all lead us to? I want to show you these numbers and kind of show you the powerful advantage that this strategy can provide just looking at the numbers. So what I'm going to do here, I'm using another simple calculator tool that we've got with one of our software programs to kind of illustrate the power of these index crediting strategies. So for this illustration, I'm going to say, let's say we have a 12.5% cap on our index crediting strategies, meaning if your money gains more, if that index rather gains more than 12.5% in any given year, you are going to be capped at 12.5%. So if that index gets a 20% gain, you're going to be credited with 12.5%. But anything below that, you're going to get the full amount. So if the index climbs, say 11%, you're going to get the full 11%. So hopefully that makes sense. We're going to say, just for the sake of illustration, let's use $100,000. And let's go back and we're going to compare with how that would have performed against the S&P 500 had that money been invested in the market throughout this entire period. So I'm going to go back, let's say 25 years. So This is going to show me numbers through 2018. So let's do 1993 through 2018. I'm going to click this calculate button here, and we're going to see these results. So one of the things I want to do here, let's see if we can do this. We use this so I can kind of draw. So if you see here, the market strategy with the S&P 500 is here on the left. The index strategy is here on the right. So what you see here each year on the left, you see the actual rate of return, including dividends, from the S&P 500 every year. And then you see on the right the index crediting rate that you would have been credited had you been utilizing this strategy over those years. So if you look here at some examples to point out, showing you how the index crediting strategy applies when the resulting market gains or losses are outside of the parameters between 0 and 12.5%. You see here that in 1995 through 1999, we had a strong bull run there, 4 years in a row. Some really solid gains, 34%, 20%, 31%, 0.67, almost 20% in 1999. So all those gains in the market, and then the resulting credit with the index crediting strategy is you are simply capped at 12.5% all of those years. However, look at the very next year. You see here that in year 2000 there was a 10% loss. And with the index crediting strategy, because your downside protection floor of 0, you get a 0 credit, so you don't experience any of the losses. So hopefully that makes sense to show you how the index crediting strategy works and the net effect. But more importantly, let's scroll down and see the end result. So this is what really matters. All these metrics about rates of return and all this mean absolutely nothing to you. All you really ultimately care about is how much money do you have in your account, how much money are you going to have at any given point in time or at retirement. So with the market strategy, look at the average annual rate of return over that 25-year period, almost 8.5%, compared to the index crediting strategy, which was a full 1% less than that at 7.44%. So you earned a full 1% less with the index crediting strategy than you did with your money just in the market at 8.44%. But look at the bottom line dollars. Your $100,000 in the market yielded you just a little over $570,000 at the end of that 25-year period, while the index crediting strategy left you with almost $624,000, a gain of $53,000. Now guys, this is not fuzzy math or some wacky math trick. This all goes back to understanding that average rate of returns mean nothing when volatility and risk of loss is in the equation. You have to be able to go back and calculate a real rate of return, an actual annualized rate of return that takes into account the effects of negative compounding. And if we were to show you the real rate of return on these two strategies, I can assure you, because it's mathematically impossible, that the market-based strategy, even though it was 8.44% average rate of return, the real rate of return is less than what the index crediting strategy provided you, because the net effect is comparing the bottom line dollars, you're left with more money in the index crediting strategy. So hopefully that makes sense, guys. That's all I wanted to point out was, again, not getting into too deep into the weeds about specifically, the mechanics of how these companies design and execute these synthetic index crediting investment strategies, but more importantly, what is the end result? And the end result is that, at the end of the day, you get to participate in either all or at least a good portion of the upside market gains, but more importantly, you are provided that downside floor and protection of 0, so that again, you get to lock in those gains every single year, and you never run the risk of losing money and having your account balance move backwards. So hopefully that illustrates the tremendous power and advantage that these strategies can provide. As I talk with everyone when we discuss these strategies, this is not a get rich quick type of strategy, but if you like the idea of being able to lock in, 6 or 7% types of real rate of return and eliminate the risk of ever losing money and having your account balance ever move backwards in any given year, then these strategies can be very effective and tremendously valuable. So